Hi there, and welcome back to Entrepreneurship 101. Today I'm going to be talking about the six main sources of funding for a startup. The first one we're going to talk about is friends and family. Understandably, this is the first place that many startups turn to when they begin the process of raising money. Friends and family, of course, are a personal connection, which oftentimes means that if financially able, these groups would be willing to fund a particular startup. Startups can actually learn a lot about where their company stands as well during the process of turning towards friends and family. Because if those two groups aren't willing to believe in your product or service and aren't willing to back their belief with some type of financial contribution, then it really should be a signal to the co-founders and to the startup as a whole that they may want to reevaluate their larger plan and or the product or service itself. Now, friends and family also come with some disadvantages. First is that sometimes mixing business life with professional life can be a dangerous move for the long term. We saw this with Sitter City, and in that case, it turned out for the most part okay. But we did see some challenges when you mix either your romantic life with your business life or just your family life with your business life. There can be some complications that come with that. And secondly, friends and family may not always be as well connected as an angel investor or a venture capital firm would be. So these are all things to take into consideration. The next funding avenue comes in the form of angel investors. So angel investors are wealthy individuals that invest their own money in startups. And oftentimes they kind of offer they give money. They also take on a sort of advisory role with the startup. Many of these angel investors actually previously had run companies of their own and been very successful, made a lot of money, and acting as an angel investor is a way for them to kind of stay active and be a part of the larger entrepreneurial community even after they've kind of moved on from their particular business that they'd once run. Angel investors represent a more proper form of raising capital when you compare it to going to friends and family. But this doesn't necessarily mean that it's better than family and friends. It just formally it's more formally recognized as a means of funding. Angel investors want to make sure that there's an exit strategy in play. They want to know how, in the long run, they're going to end up getting their money back, right? Because at the end of the day, they want to be part of the entrepreneurial community. They would love to play a role as an advisor. But at the end of the day, they want to make their money back. So they want to make sure that there's an actual exit strategy that's in play and actually been thought through. But there's also, like everything, disadvantages and risks that go along with angel investors as well. Because angel investors are just individuals rather than a company or a firm, they don't have the same type of pressure to maintain a particular reputation that a larger company or VC firm might have. So most of the time this is fine, but this is something to keep in mind for a startup when they're considering where they like to raise their money from. But now using the opposite side of things, a positive spin on it is that since they are individuals and not larger firms like a VC, they don't have to abide by the same type of strict regulations that the larger companies and venture capital firms have to. And this is a big positive that can be nice and very helpful for many startups. The third source of funding comes in the form of incubators. So incubators invest small amounts of money in earlier stage startups. They have startups they invest in actually come and work within their workspace. The startups usually stay and work within their space for anywhere between 1 to 5 years. Professor Cohen wrote that incubators tend to nurture nascent ventures by buffering them from the environment to give them room to grow. So like the word says, incubate. So companies come in, they work in their workspace, and they're given kind of a protective environment in which and the idea is within this protected environment, it will allow for their company to grow best. Now, one potential issue with this is that sometimes a startup can actually thrive in this environment, this incubator, but when they get out to the real world, since they've been developing and growing and maturing as a startup and as a company in an artificial situation, it doesn't necessarily always reflect the realities of the real world and the marketplace. And so sometimes there's an issue making that transition from an incubator to the real world. So incubators are actually quite opposite from our next avenue of funding, which are called accelerators, and they're actually very, very popular nowadays. While angel investors and incubators are continuous in nature, accelerators are based on the premise of much shorter durations. So the idea is that if you're a startup, you go to an accelerator. Early stage startups, all of this is dealing with early stage, whether it's angel investor, incubator, or accelerator, or friends, family, for the most part. They're all dealing with very early stage companies. But with an accelerator, right, they're taking you in as an early stage company, and they're doing a lot of similar things that incubators do, but instead of 1 to 5 years, it's several months. So many of them it's 3 months. And Professor Cohen goes on to say that accelerators, what they do is they speed up market interactions in order to help nascent ventures adapt quickly and learn. So really, in many ways, very opposite, very different from incubators. Incubators want to create kind of a safe community, safe environment for the startups to, they believe, to best grow and mature. And accelerators are accelerating the process. They're not giving you this comfortable environment. They're accelerating. They want rapid improvement, and they think this is the best way in which so when it comes time for you to graduate their program, you'll be ready for the real world. You'll be ready for the marketplace. So accelerators offer, small amounts of seed money. They offer a place for them to actually physically work, and they also offer help and guidance with defining, building initial products, identifying particular customer segments, and also securing other resources. So that might be getting, a relationship with a particular VC or particular advisory board or whoever it may be. Accelerators and incubators, in this case, help you, when you're done with the program, they help you make those connections that are really pivotal. And next, we're going to look at venture capital firms. So VC firms are different than these previous avenues of funding, very different. They are larger companies that invest huge amounts of money, huge amounts of other people's money, and we're talking millions and millions of dollars in startups. But the main difference is their funding tends to come later in the life cycle of a startup. And oftentimes it's much harder to get VC funding because you're dealing with such large amounts of money. There are some downsides to everything with VC funding. When you receive this type of funding, it comes with sometimes very tough terms and regulations. And it's important to note that when a startup accepts a deal with a VC, the founders of the startup no longer have complete control over their company. Now, this is true to various degrees for many of these other avenues of funding I've mentioned. But like I said, since VCs are dealing with such large amounts of money, the terms of their agreement can, like I said, it can be much harsher. And so oftentimes what you see is co-founders will lose large amounts of their ownership and their control of the company in exchange for these huge sums of money that they get in return. VCs are based on the premise that if they make 10 investments, they're just looking for one of those investments to be a success. Because when VCs win, they win big. And a downside with this is that VCs aren't necessarily, many are and some are, but they aren't necessarily always looking out for what's in the best interest of the particular startup. At the end of the day, they just want one. They out of their batch of 10, but they want one success, and so that environment doesn't always necessarily lead itself to what would be best for the startup at the time. And finally, we will end with crowdfunding. So we see this in sites such as Indiegogo and Kickstarter. This will be brief because I know this has been a longer and a lot of information in this episode. Crowdfunding boasts, to be honest, very little downside and it's coupled with a tremendous upside. It's a great way to raise money. It's also a really great way to do primary research on your product. You can do this by gauging interest on your product or service through seeing whether or not you were able to raise the amount of money you set out to raise. How much it's a great way to see how much interest is. If you're trying to raise $10,000 on Kickstarter, right, and you're able to raise $60,000, wow, so much information you can derive from that. You know that there's tremendous interest. You know that there's demand. Opposite, you're trying to raise $10,000, you only raised $1,000, $1,500. Maybe that's a sign. It's not an end all, but it's a sign to maybe reevaluate where you stand. Also, it's been accounted for that crowdsourcing is also a great way to gain PR and marketing for simply taking part in this avenue. It's just a great way to do that. So again, all these avenues, many of them for the most part, offer both pros and cons. each of them, have their own strengths and own weaknesses, but they're each very credible, and they each should definitely be considered thoroughly by a startup when it comes time to raise capital and raise money. All right, thanks for listening to this episode, and we look forward to seeing you soon.